Good evening to all of you. This is Ranjan joining you from Smart Finance Chennai. And in this particular video, I am going to explain you how you can buy two lots of call option or put option with the cost of one. Quite interesting. So, if I can say that currently specific call options, say 15,500 call option is at 115 rupees. So, if it is 115 rupees, it is trading as of 10th March 2021. And if I am telling you that in this 115 rupees, you can able to buy 150 quantity, not the 75 quantity. So what is the trick involves in this, so that you'll be paying 115 rupees, however you will be having two lots of call option. So you can put the same stop loss mechanism whatever you want to put in a call option. However, whenever you are buying a call option, you have this 115 as the total risk involved in this call option. However, in this 115 rupees, if you can get two lots of the call option, obviously your cost becoming half. So that is a great thing to explore here. So one small way we can change our style so that we can make these things possible. In 115 rupees, I am going to buy two lots of call options. So that is same process also, you can buy two lots of put options at the cost of one. So this is possible if you can, instead of buying a call option, if you just involve a part of strategy there. So what I'm going to do here, I'm going to form a strategy. So my aim of the strategy is I'll be buying two lots of call option at the cost of one. So by this process, what happens? Your cost of call option comes down, and same process, you can optimize your profit to 2 times. So that is also one of the best benefit of this. Suppose if I am just going for this, say Nifty is currently 15,203 level, it has closed as on 10th March 2021, and I'm just going that I'm using Smart Finance softwares. So for the coming 10 days period, what will be the trend as per the prevailing volatility? So this says that if 15,300 gives a crossover, you can have a range of 15,477 to 552. So this red zone, what you are seeing here, this is the reversal zone. So this I am demonstrating with our one standard deviation real-time software. So you can just have a look at this thing. So on 10th March, we are doing these things for coming 10 days period. So we can have this kind of things, 15,477 to 552 is my reversal zone. And if it fail to hold above 15,307 and fall below 15,098, it can fall down to 14,928 to 853. So this is the calculation as per our software. And again, I am going back to the India VIX, the volatility index. This has fallen near to 20. If it is falling below 20, market will be bullish. So you have all probability to go long in the market. So this is what we have just done, a fundamental. So if you suppose, if you are convinced that okay, VIX is falling and there is a chance that market can go till 15,477 to 552 in the coming 10 days period. So if you propose to buy 15,500 call option, 500 and call options now at 150. So whatever maybe the stop loss you want to fix as per your calculation, you can fix. So if you want to buy it here, so I'll show you a trick. Instead of buying one lot at 150, you can buy two lots at 150. So for that, we have to reconstruct this entire things in terms of a strategy. So what I am going to do here, it is a very simple strategy. I am going to sell the Nifty future one lot at 15,203. I am going to buy two lots of 15,500 call option at 115. At the same time, I am going to sell a put option of same strike 15,500 strike put option. I am going to sell one lot. So this gives me the freedom to buy 15,500 call options, two lots at the cost of one. You must ask me how. So you can see 15,500 put option which has closed at 411 at the end of day 10th March 2021. It is having 411 rupees as a premium. So 411, if I can less it by 203, so I have 203. So which is my future is trading 11 3 stars. So 8. So 8 3 is 11. So here 0 0 0. So you can say so it is having. So I need to find out the intrinsic and the time value. So here 15,500 is my strike. So 15,500 and 15,203. So 500 minus 203. So 500 minus 203. So this is the intrinsic component or intrinsic value of option. 10 3s are 7, 9 zeros are 9, and here 4 2s are 2. So we have 297 rupees as the intrinsic component. So if I can less that from the 411 rupees, 297 if I can less, so I can get the time value in that. So 11 7, so 7 3 7 4 as 11. So here 0 0 again there is a carry, so 1. So here 3 2 as 1. So you can say that this particular put option of 15,500 has a time value of 114 rupees. It has a intrinsic value of 297 rupees. So what I am going to do here, I am going to sell a future, and along with that I am selling a put option. So this 114 rupees of time value is a definite gain component for me. So this 114 rupees worth of time value is a definite component for me. So this is the time value gain I can get from this trade of selling a future and selling a put option. So I am utilizing this 114 rupees to buy one more additional lot here, 15,500 call option. So what I did here, I have just bought two lots of call option at 115. However, I paid only for 115. The second lot of 115 what I am paying for, it is coming from the time value component of 15,500 put option. So in fact, if you can take a difference, you are getting just paying 1 rupee for that. So 1 rupee for that. So this particular strategy, if you initiate, so what will be your payoff? Suppose if you want that 115 rupees, if I am just taking this particular strategy, so 115 rupees, if I am just taking this call option, instead of that I am buying two lots of call option, selling a future, selling a 15,500, put option one lot. So I have two call options. Suppose if I am just holding for the same 10 days period and calculating this value, and in between this thing we have just found out that yes, we are going to a level of 15,568 level, 15,568 level. So if this happens through, then I am getting some 3 to 4,000, and if going for 650 level, 800 level, my profits are increasing. However, if there is a downfall, you can see that my loss is capped. My losses are not increasing. So it has, in fact, it is reducing as the fall continues, and it is after a specific period, it is getting constant. So because only one lot of 115 into 75, 7,500 what I have paid, that is my maximum loss. So in the uptrend, my profits are increasing. In the downtrend, my losses are capped here. So instead of buying one lot of call option, if you can implement this kind of one strategy of having a covered put along with two call options long, having a covered put along with the two call options long. So you are going to get involved in the bullish market. However, your risk is distributed and you are going to involve in the same bullish market with risk distributed. Same process also, you can have a put option also. So same process, if you are having also, you can have a put option also. Suppose if you just want that, I want to buy 15,000 put options 2 lot. So 15,000 put options, I want to buy 2 lots at the cost of 1. So how you can do? So same process you can follow here. Instead of that, have a covered call, buy a future. Along with that, select call options of 15,000, 1 lot. So which will be having 176 rupees, 203 as the intrinsic component, 176 is the time value component, and you are going to buy 15,000 put options here, put options 15,000, 2 lots you are going to buy at the cost of 1. So 172, so almost you can say that 176 rupees of time value you are getting from this 15,000 call options, and same process you are 172 you are paying. So in fact, you are buying the two put options at the cost of 1. So here too also you can say downward your profits are increasing, but when it move upward, your liabilities are properly capped here. Even though if it is going to 16,000, your liability is not increasing. 15,500 liabilities are not. It is just perfectly capped. Post 14,000, the liabilities are not increasing. But in fact, when it is a big fall, your rewards are increasing. And you can form a combo also. You can form to gain from the positive delta in the call option or gain from the call option in Nifty, and same time try to make a similar strategy in the bank Nifty to gain from the put options. So here idea is to buy two call options at the cost of 1. So keep following this particular strategy, and this is I have demonstrated with our softwares on option strategy and our softwares on 1 standard deviation. I'll again request you for the coming 10 days period, do follow these levels of Nifty, what has come in this 1 standard deviation software, to know the authenticity of this tool. And if you need further more details about the Smart Finance product or services, please visit our site smartfinancing.com, and here in the product link you will get all details about our products and services. In case of any query, feel free to call us in these numbers. Thank you very much. Thank you for your time.